expected to slow sharply over the first half of the forecast period. That predominantly reflects the significant adverse impact of the sharp rises in global energy and tradable goods prices on most UK households' real incomes. It is a measure of the scale of the shock that total real household disposable income is projected to fall by 1.75% in this 2022, which, apart from 2011, would be the largest contraction since comparable records began in 1964. And I must say that I recognise the hardship this will cause for many people in the UK, particularly those on the lowest incomes, often with little or no savings, who are hit hardest by increases in the prices of basic necessities like food and energy. As a result of the associated decline in activity, although the unemployment rate is likely to fall further in the near term, to 3.6% in Q2, it is projected to rise to 5.5% in 3 years' time, given the sharp slowdown in activity. With monetary policy acting to ensure that longer-term inflation expectations are anchored at the 2% target, upward pressure on CPI inflation is therefore expected to dissipate over time. Global commodity prices are assumed to be consistent with the conditioning paths for energy prices and so rise no further in the central projection. Global bottlenecks are expected to ease over time, and the weakening in growth and building excess supply leads domestic inflationary pressures to subside. Once CPI inflation starts to fall, it is projected to fall relatively quickly, to a little above the 2% target in 2 years' time, largely reflecting the waning influence of external factors, and to 1.3% in 3 years, well below the target and mainly reflecting weaker domestic pressures. The risks to the inflation projection are judged to be skewed to the upside at these points, given the risks of more persistent strength in nominal wage growth and domestic price setting than we have assumed. I'll now turn to the monetary policy decision. The MPC's remit is clear that the inflation target applies at all times, reflecting the primacy of price stability in the UK monetary policy framework. The framework also recognises that there will be occasions when inflation will depart from the target as a result of shocks and disturbances. The economy has recently been subject to a succession of very large shocks. Russia's invasion of Ukraine is another such shock. In particular, should the current very elevated levels of global energy and tradable goods prices prove persistent, this will necessarily weigh further on most UK households' real incomes and many UK companies' profit margins. This is something monetary policy is unable to prevent. But what monetary policy can do is to ensure that, as this real economic adjustment occurs, it does so in a manner consistent with achieving the 2% inflation target sustainably in the medium term, while minimising undesirable volatility in output. Recent developments have exacerbated materially both the near-term peak in CPI inflation and the prospective negative impact on activity and medium-term inflationary pressures. Nevertheless, given the current tightness of the labour market, continuing signs of robust domestic cost and price pressures, and the risk that those pressures will persist, the committee voted at this meeting to increase bank rate by a further 0.25 percentage points to 1%. Based on their updated assessment of the economic outlook, most members of the committee judge that some degree of further tightening in monetary policy might still be appropriate in the coming months. There are risks on both sides of that judgment, and a range of views among these members on the balance of risks. The MPC will continue to review developments in the light of incoming data and their implications for medium-term inflation. Given the uncertainty around the outlook, it is unsurprising that there were a range of views amongst members of the committee about the extent of tightening required at this meeting and in the coming months. This reflects the narrow path we're navigating, given the magnitude of the risks on both sides of our inflation projections. Reflecting the risks on one side of that narrow path, at this meeting, 3 members preferred a 0.5 percentage point increase in bank rate. Reflecting the risks on the other side, however, there were also a range of views about the need for and extent of any further tightening in policy in the coming months. While most members judge that some degree of further tightening might still be appropriate, some members judge that the risks around activity and inflation over the policy horizon were more evenly balanced and that such guidance was not appropriate at this juncture. Finally, the MPC is providing further information on unwinding the stock of assets previously purchased as part of the QE programmes. As bank rate is being increased to 1% and consistent with the MPC's previous guidance, the committee will now consider beginning the process of selling UK government bonds held in the asset purchase facility. The committee recognises the benefits of providing market participants with clarity on the framework for any potential sales programme. The MPC has therefore asked bank staff to work on a strategy for UK government bond sales and will provide an update at our August meeting. This will allow the committee to make a decision at a subsequent meeting on whether to commence sales. I should reiterate that no decision on whether to commence sales has yet been made. The committee reaffirmed that that decision will depend on economic circumstances, including market conditions at the time, and that sales would be expected to be conducted in a gradual and predictable manner so as not to disrupt the functioning of financial markets. Thank you. Ben, Dave and I will be happy to take your questions now.
Thanks very much, Andrew. As always, please wait for the microphone to get to you, and also if you could identify yourselves and your media organisation. Go to Faisal first, and then I think Ed, please.
Thanks, Governor. Faisal Islam, BBC. This appears to be very close to a recession. I don't know how you define it. How can you justify to households hit by this cost of living crisis further exacerbating that in the middle of what looks very much like a recession?
Well, thanks, Faisal. As you say, it is a very weak projection. It's a very sharp slowdown. There's a technical definition of a recession. It doesn't meet that, but put that to one side. It is a very, obviously, sharp slowdown in activity. So, turning to the question, I mean, it's a very good question about why, therefore, should we increase bank rate at this point in time. And I would come back to this analogy that I used and have used recently of this narrow path. And the challenge, of course, is that on the other side of the path is where inflation currently is, but more particularly the risks as we see them going forwards. And I would highlight, as we say in the minutes, actually, in the statement, that the risks are, if anything, on the upside, we think, to inflation going forwards. And that comes, I think, I would highlight two things. One, and we pointed to it, that we have a very tight labour market. So, we have unemployment currently at 3.8%. We think it will actually go down somewhat. And, of course, it's interesting looking back, I think, over the last 2 years or so as to how much we now know. And I would emphasise now know because there was huge uncertainty through the COVID period on this question. And it's a very, very important question. But, of course, the unemployment path has been very different. And the labour market is very tight. I mean, I spend a lot of time going around the country talking to businesses. I'm sure you do as well. And frankly, the first, second and third thing they want to talk about quite reasonably is the tightness of the labour market, the challenges they're having in recruitment and what that means for pay. The second thing is I would highlight on this risks point is that one of the things we've highlighted before is that the COVID period did lead to quite a substantial build-up in unexpected saving in the economy. So the question, of course, continues and under this new, if you like, setting of the state of the economy is how exactly are those savings going to be used, and are they going to be used to sort of, if you like, buffer demand? But of course, then we have to look at that from the point of view of the risks to inflation. So the point being is we are walking this very narrow path now. And to your question, I mean, the approximate reason for raising bank rate at this point is not only, I mean, it's not only the current profile of inflation and what is to come, and of course what that could mean for inflation expectations, but the risks as well. And I would particularly emphasise the risks. I don't know, Ben, do you want to?
No, I think that summarises it well. We're in a very difficult position, reflecting the nature and the scale of the shocks we're facing. And as the Governor said in his opening remarks, the effects of those on real incomes are unavoidable, unfortunately. They're externally driven and not something that monetary policy is really in a position to offset. And it really is important, I think, to keep in mind their enormous scale. The Governor gave a figure for the estimated or predicted increase in the Ofgem energy cap this year, an estimate based on where the forward market is at the moment, of I think around £1,500 per household. Very significant. That comes off on top of what was, I think, something like £250 or £300 rise last year. If you include the rises driven by a mixture of the pandemic and the Russian invasion in prices of other imported goods, traded goods, you can probably more than double that increase in energy over that 2-year period. So we're talking about a very significant hit to incomes. The rise in mortgage costs as a result of rising interest rates is a fraction of that number. I don't know the number precisely to mind, both are estimates, but I'd be surprised if it was much more than 1/10 the rise. So that's the unfortunate position we're in. This cost of living crisis, the hit to incomes is unavoidable. The judgment the committee is having to make is, as Andrew said, between the two-sided effects of this hit. On the one hand, high inflation now could persist for longer if it gets more embedded in domestic prices. On the other hand, significant hit to incomes and thereby spending and domestic demand will push down on inflation over the medium term. And those are the two things we're trying to balance.
Ed?
Thank you. Ed Conway from Sky News. Governor, it's really just to kind of follow on from that point. Would you say that, you know, this pain that households will be facing over the next 12 months, 24 months, you know, higher inflation, fall in their standard of living effectively, is that necessary? Is that the only way of getting inflation down? Is that the medicine we need to take? Is that what you're suggesting?
Well, I think the first thing to say, Ed, and this is really the big difference in a way between, you know, as I explained, drew the sort of contrast between the US, the Euro, and the UK. The biggest driver downwards of inflation is the shock to real income. This is the point that Ben's just made, really, which is it's not monetary policy, it's the shock to real income, which, as I said, is I think, barring 1 year, is the largest since records began. And that is why, you know, we've been quite careful, therefore, about calibrating what the appropriate response of monetary policy should be to it. I mean, I would note that, as you can see in the monetary policy report, that the profile that we published for constant interest rates on the previous setting on the previous setting, it would not bring inflation back to target. And obviously we looked at that a lot, as we tend to do during the process. But I would emphasise this point that in terms of pain, I'm afraid Ben has made the point very, very well. The biggest, in a sense, driver is the real income shock, which is coming from the change in the terms of trade, coming particularly, as we said, from energy prices, and also now, also from some core goods and some food sources.
In respect to that, therefore, I don't think it's right to say it's the medicine. It is its own medicine. The shock that is pushing up prices.
Let's come out of that press conference now. Just to quickly mention as well the market reaction to the Bank of England statement and press conference. The British pound's down 1.8% as we stand against the US dollar today in reaction to this negative outlook for lower growth and higher inflation. Simon French, chief economist at Panmure Gordon, able to join me now to add his reaction. And clearly, Simon, this is not an optimistic outlook that we've gotten from the Bank of England today, but are there some factors that their outlook is based on that might not materialise and therefore things might not be as bad as they're predicting right now?
Yeah, well, one of the reasons why sterling is so weak, and you showed the data on the screen for your viewers, is that the market had been ahead of this announcement, expecting this to be the first interest rate increase of a further 6 or 7 this year. Now, I think what we saw in both the commentary from the Governor of the Bank of England and indeed in the Monetary Policy Report is that is now very much open for question. Whether the Bank of England think the economy is strong enough to take that level of interest rate increases which is what the forecast is conditioned upon, is now very much open to question. The other thing, of course, is that the Bank of England is assuming a 40% increase in energy bills on top of what households are already paying, and yet assuming that the government stands by and does nothing. I don't think that's realistic in the fourth quarter of the year. I think the government would have to respond if that price increase came through.
So there are some levers, I guess you're saying, that the government could pull potentially. But if we're talking just about what the Bank of England can do and should do, yes, the prospect of lower growth, of course, is a bad thing. But high inflation can be self-fulfilling and can make the outlook for growth even worse. And when you are forecasting now double-digit inflation, over 10% inflation, this increase in interest rates from 0.75% to 1% is relatively small, even if, as those questions from Ed Conway rightly suggested, that this is going to be an increase in interest rates that will hurt people.
Look, it will hurt people, and I think Andrew Bailey was at pains, and he's going to be at pains for some months to come, to say this is not something he or any other policymaker feel comfortable about, because what has happened is there's a huge energy price shock that is pushing inflation up to north of 10%. That the UK policymakers, be they at the Treasury, be the Bank of England, are fairly limited in what they can do to respond to that. And households have got to take, unfortunately, a lot of the pain, which in and of itself will start to bring inflation down. The delicate calculation the Bank of England have got to make, and the Governor Andrew Bailey, is the degree to which that is self-correcting and will get inflation down to 2%, or whether, and you're absolutely right in your question, whether a 10% inflation will start to have what is known as second-order effects, wages, other prices start to go up far more than 2% on a sustained basis, and therefore starts to squeeze cost of living, not just through the energy route, but through all products that households and businesses buy.
And then just quickly, Simon, clearly those forecasts we've been touching on, particularly from the second half of this year and next year from the Bank of England, are pretty gloomy in terms of outlook. What about the effect of what they've done today? They've increased interest rates by 25 basis points to 1%. Does that hit consumers immediately? Does it have an immediate effect, or does it take a bit of time, and is the effect relatively small in the short term?
Well, this is the silver lining, actually, if you like, to what is a difficult message from the Bank of England. 80% of mortgage debt in the UK, about £1.4 trillion worth, is actually on fixed rates. So those don't change. Those lenders can't change that overnight. Over the course of the next 2-3 years, those will start to go up, but that is very much pain deferred. We also mustn't lose sight very quickly on the fact that savers, long-suffering savers for more than 12, 13 years, facing very low interest rates, now get a bit of a boost, and there'll be all eyes on banks to see whether they pass through that extra 25 basis points to savings accounts.
Simon French from Panmure Gordon, thanks so much for joining us on that news that the Bank of England's hiked rates to 1% and lowered their forecast quite significantly of the outlook for growth in the UK economy in the next year or two. The British pound is down nearly 2% against the US dollar in light of that. We're going to have much more analysis of this and from Mark Austin on the ground in Ukraine on Sky News.